Welcome back. Still watching Business Morning here on Channels Television. As we speak, the Monetary Policy Committee of the Central Bank of Nigeria is meeting. The meeting started today, ends tomorrow. So by tomorrow, we do expect to get their decision. And here on Channels Television, as usual, we're bringing you live announcement of that to hear what the MPC has decided. But now let's maybe talk around that and see what to expect from them. Joining us from Reading is Dr. Adesola Sumoni, Senior Analyst with Financial Derivatives Company. Hi, I know you're in the UK, but I mean you have your ears close to Nigeria, Adesola. So thank you so much for your time this morning. The MPC has started its meeting this morning. What is FDC expecting or projecting?
Thank you for that question, Ine. For some context, this is what we call monetary policy making in transition, right? Because this is the last meeting under this current administration, right? So at times like this, usually the Monetary Policy Committee tries not to make any decision that would like startle the market or that would handcuff or constrain, the incoming administration. Now, having said that, the MPC is meeting against a backdrop of tighter financial conditions globally. We've seen many central banks increase their benchmark interest rates. In this month alone, we've seen 3 central banks in the developed world. We've seen the US, we've seen the Bank of England, and the European Central Bank all increase their benchmark interest rate by 25 basis points. We're also seeing some financial fragility coming on the back of, the banking failures or the banking failures in the US and Europe, and also the contagion, although that has been muted, but it is still lingering. And there's also the issue of this US debt ceiling drama and how it affects emerging market economies like Nigeria. On the domestic front, we are seeing issues like persistent, relentless inflation. The numbers for April came in at 22.2%, up from 22.04% in March. And it is also more than double the central bank's upper limit of around 9%. And we are seeing a slowing economic growth. We forecast that GDP growth for Q1 2023 would come in slower, I think about 1.6%, owing to many factors. But one of the key factors is, the Naira crunch we had earlier in this year. We also have factors like the market is awash with money supply. Broad money supply is up, I think, around 19% year on year. Taking all of these factors into consideration, we also have the issue of the weak currency. The Naira has depreciated quite remarkably to around 740 Naira to the dollar. And the external reserves down, I think, to around $35 billion from around $40 billion at the beginning of the year. So taking all of this into consideration, with the first scenario we foresee with 70% probability is that the Monetary Policy Committee will further hike benchmark interest rates by around 25 basis points in order to, still try to rein in inflation. It's important to note also that, since around April last year, the Monetary Policy Committee has increased benchmark interest rate by around 6%, but we are seeing inflation being, relentless. The second scenario with 30% probability is that they would hold all monetary policy parameters unchanged.
So FDC is projecting a steady stance?
70% probability of 25 basis points increase. That's our forecast.
Okay, all right. Then, you mentioned something about the value of the Naira, and I know that one of the things I've also seen recently, even from FDC, is the issue that it seems we have an additional window now for FX. The IATA window, so now we have like 4. We have the parallel market, which is most accessible. Then we have the I&E window. We have the NAFEX, and that's adding the IATA window. I do know that the central bank did pay the airlines, the foreign airlines, on 600, I think 650, 680. well, I didn't know that was supposed to be like a window, and I guess that's another layer of problem when we look at the issue of FX and the management in the country.
I mean, for the issue of FX, it's been here for ages, and it's only getting worse because, for example, if you look at our inflows of FX, because of first, the tighter monetary conditions globally, we are seeing smaller and smaller foreign capital investment. Also, because of the business environment in Nigeria is kind of very, very tricky at the moment, we are not seeing a lot of foreign direct investment. Apart from that, we're also seeing a smaller oil receipts. If you look at our oil production for April, for example, according to some sources, was less than 1 million barrels per day against our OPEC target of, I think, around 1.8 million barrels per day. So there's issues around inflow, and what the central bank is trying to do is just trying to manage manage the outflow of FX so as to keep the external reserves a little bit robust. But in the midst of all of this, you mentioned the central bank tried giving some funds to airlines. The truth of the matter is the backlog is so huge, right? And because of these, airlines are not able to repatriate their funds they're not able to repatriate the funds back to their country. They have to change the rate at which, the exchange rate at which they charge their tickets, and that is why you see airline tickets now, particularly international travel, is significantly high, and that also even fed into the inflation numbers for April.
So, talking about FX now, this whole talk about U.S. debt ceiling and debt default, how does that affect Nigeria?
Okay, I'll give you a background. So, for those who don't know, the idea is that the U.S. operates a deficit budget, which simply means that it spends more than it earns in terms of revenue, and the U.S. Congress sets like a ceiling or a limit on how much the U.S. government can borrow. That limit is currently $31.4 trillion US dollars. However, that limit was reached in January 19, 2023, and the U.S. Treasury tried some short-term measures to make sure that the U.S. is still able to meet some of its short-term obligations. But those measures expire in June, on June the 1st, and that is why there's a lot of scramble, there's a lot of debate on either raising the ceiling or suspending the ceiling altogether. Now, there are significant big implications if that debt ceiling, if nothing is done, and if the U.S. now begins to default on its debts, it begins to be unable to pay some of its bills, it has huge implications for both the U.S. and the global economy. But the consensus or the expectation is that that the Democrats and the Republicans are going to reach a deal, even though the deadline is approaching quite soon. The consensus is that they'll reach a deal. Now, once they reach a deal, I think that is what we need to talk about. Once they reach a deal, what is going to be the effect on a country like Nigeria? What would happen is that the U.S. Treasury would try to, shore up some of the cash it has used in this period since January up until now. It's going to try and shore up some of the cash reserves to boost its buffers. So it's going to be selling a lot of treasury bills. So there's going to be like what's it called, a sharp drain of liquidity out of the banking system because of the treasury will be selling a lot of treasury bills and bonds. So there will be a sharp drain in the liquidity in the banking system. And some analysts have estimated that this would be equivalent to, I think, $1 trillion by the end of Q3. And some have even said that it's equivalent to a 25% basis points increase in benchmark interest rates. And what would that do? Well, it's going to increase cost of borrowing. We are going to see some capital flight away from emerging market and frontier market economies, or we'll see smaller capital inflows. And because of the capital flight, because of the higher interest rate, because of the tighter financial conditions globally, that would further pressure the exchange rate of emerging market economies such as Nigeria, and also put some more pressure on the external reserves.
That's what I heard from you, and that's a good one. But thank you so much, Dr. Adesola Sumoni. We might have to be paying more for our debt servicing now, because it's very unlikely that we would see the U.S. defaults. Most likely. Yes. most likely they're going to move the ceiling, and then, and then we have to pay for it, and then, just as you noted, mop up all those liquidity and make funds more expensive for, other countries. But thank you so much. This is the reality of our time. At this time, Dr. Adesola Sumoni, Senior Analyst with Financial Derivatives. Enjoy the rest of your day.